What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Welcome back to The Last Trade. Exciting week. Bitcoin's pushing towards 27,000 again. We've got a lot of news. We were mentioning Deutsche Bank just announced today that they're going to begin custodying crypto assets for their clients. So I think that's the first big bank mover into the custody game. And we were joined by Chris Kyper, the director of research at Fidelity Digital Assets. I paused there because Chris, I asked how to pronounce your name before, and he said it's Kyper, like diaper, and I almost said Chris Diaper. I'm sorry.
You got it. My mnemonic almost failed. It's supposed to put it in your brain how to say it, but you almost said the wrong thing. That's all right.
Well, thank you for joining us today.
Thank you. It's my pleasure to be here.
Yeah. Well, we had a great intro call yesterday. I think the big theme that we pulled from that was, I think, just the admiration that Michael, myself, and Jesse have for the work that Fidelity has done in the space for some time now, coming up on a decade, I believe so. Your annual research pieces are incredible. Obviously, you're the director of research, so you have a lot of say over what goes into those pieces. So before we jump into the broader discussion, I think just an introduction to yourself, how you got into the position of director of research at Fidelity Digital Assets, and I guess we can start there.
Yeah, sure. Well, thanks again for having me. Chris Kyper, Director of Research at Fidelity Digital Assets. For those who don't know, Fidelity Digital Assets is a subsidiary of Fidelity Investments. So it is a separate Fidelity entity dedicated to the digital asset space. We'll talk more about it, I'm sure, but our core product that we started with and we continue to use today is our custody services. So we offer cold storage custody for digital assets for our institutional clients, as well as a platform and execution to help them buy, sell, and hold digital assets. My journey or kind of origin story, I did the traditional financial TradFi world kind of stuff. I got out of college in 2009. I wanted to go into capital markets, worst time ever, of course. So I started in banking as a credit analyst for a couple of years. Then I got to make the jump to a money manager in Chicago. We had about 30 billion under management there. And I was analyzing tech stocks. I love technology. I'm not a computer programmer or anything like that or a developer, but I've always built my own computers and just wanted to experiment with stuff. So it was actually through the tech side, believe it or not the finance side, that I first heard about Bitcoin. I heard about it in some tech magazine or blog. And I was interested, like, what is this from a technological perspective? I read about it, researched it. I made my first Bitcoin purchase in 2012 or early 2013, I think it was. Whenever it was trading at around $40, $45, I just bought a couple and said, I got to experiment with this. I got to trade it, sell it, move it around. And of course I did all the stupid stuff. I bought stuff with it. I lost it. I basically traded and gambled with it. So lest anyone thinks I'm a Bitcoin billionaire sitting on $40 Bitcoin, I did all the things that everyone does with it. It wasn't until later where I did this deep dive into it, especially the economic side of it. My other passion is economics. And I was just talking to Marty, recognizing a lot of the books behind him on the bookshelf there. Studied that in grad school and was this nerd that loved monetary theory and history. I went to George Mason University for my master's, and there's a professor there that I said, I have to take a class with him, Dr. Larry White. He's the foremost expert on free banking. So he knows a lot about private currencies and competing currencies and all of that. So that's when it really started to click with me on the econ side of what Bitcoin is as an asset and this aspiring money. And so I kept working in the finance world after that. And then eventually these two paths kind of merged, and I had the opportunity to come over to Fidelity, and I've been absolutely loving it ever since.
Yeah. I'm jealous you got to study under Larry White. I saw him do a Soho Forum debate with, I forget his name, but he was one of the biggest proponents of NERP. Essentially, it's bugging me that I can't think of his name, but it was an incredible debate. Larry, Professor White, won the debate pretty handedly. But I know we have a whole list of topics to go on, but the whole idea of free banking on Bitcoin has always fascinated me because of the infamous Hal Finney post to bitcointalk.org, I believe it was in December of 2011, where he essentially said that we may be able to create like a free banking system on Bitcoin, having a bunch of private banks use Bitcoin as a reserve currency and then issue monies on top of that. And it's not the most popular idea in Bitcoin, but it's one that has always stuck with me and sat in the back of my mind. Like, it seems like it could be possible.
Well, aren't we kind of already in the Bitcoin free banking where, you mentioned Fidelity's been around for a while. They seem to be doing okay. And there's some others that aren't around, and the market has decided who stays around and who kind of maybe goes a little further on the risk curve than they should.
Ken Rogoff was the man he debated.
Oh, sure. Yep.
He buried
the
Rogoff.
Famous Rogoff and Reinhardt paper and book. Sure.
Yep. Do you think free banking is possible on Bitcoin?
Personally, I'm not sure. I mean, I think it is, but I haven't studied it enough yet to say. But I guess I don't see why not. Studying under Dr. White, he's basically documented all the places throughout history where free banking was in existence and where it was actually very successful. I think it was like Ireland and Scotland, if I'm remembering correctly. Mm-hmm. One of those periods was well over 100 years. So if it can work back then with their relative rudimentary accounting and paper, how much more so could it work today, I guess, is kind of my theory.
Yeah. And from like a scaling Bitcoin perspective, when you think about the limitations at the protocol level and the fact that not every human on earth is going to be able to actually own a UTXO, the concept of free banking is an interesting way to attempt to scale Bitcoin to billions of people in the future.
Yeah, there's some practical realities about Bitcoin that are, I suppose, some of the like uncomfortable topics where, it's a source of FUD for a lot of people, especially altcoiners, about how there's only 7 transactions per second. And so how could the world possibly, adopt Bitcoin as a practical medium of exchange currency? And well, the answer to that is it's not going to happen on the base layer. It's not going to happen on chain. The 7 transactions per second limitation is only at the base layer. And of course, it's going to, we're scaling on the second layer with Lightning and other solutions. And the reality with those implementations is that you kind of end up with, a third party that you're using as a service to use their infrastructure to, Lightning channels to transact, your value on the Lightning network. And then you don't have total autonomy and control of your payment infrastructure at that point, because you're sort of piggybacking. You're paying as a service for somebody else to provide part of the infrastructure that you need in order to transact. And now you're starting to approach banking in that sense. And so, that there's a path for that to continue to develop. And so long as you have an honest and true measuring stick that nobody controls, I don't see why not, why free banking can't continue to naturally, organically develop in the free market. And I think the Lightning Network is sort of an indication of the early stages of that process playing out.
Yeah, and then on top of that, things like Fedi mints, these Chaumian mints, which can act like individual private banks, federated banks, on top of the protocol level that are interoperable with Lightning. It seems like the experiment is being played out in real time, but we're not here to talk about free banking, even though it is an interesting concept. We're here to talk about what you're doing at Fidelity. And again, like going back to what we said earlier, Fidelity has been a staunch supporter of Bitcoin for almost a decade now. And I think Abby really sticking her neck out there in 2014 and saying, hey, we're going to begin transacting in Bitcoin in our cafeteria. We're going to really dig into mining. We're going to support people like Bob McElrath and others to really dive into what's going on here and try to figure out the custody side of this Bitcoin thing. They did it early, a prestigious 75-year-old institution handling over $1 trillion of assets. What, in your mind, Chris, really sets Fidelity up to make a move like that pretty early on in Bitcoin's life cycle?
Yeah, sure. So this was one of the things that attracted me to Fidelity, and I did not know. So I love telling this story to people because I think they should know about it. But they always say, how did Fidelity get into Bitcoin and digital assets? Did you just jump in in the last bull run? And it's like, no, absolutely not. They were very methodical. They thought about this. And as you said, they invested a lot of time and resources. So really the story goes back all the way to 1999, a decade before Bitcoin even existed, with the creation of this internal group or business in Fidelity called the Fidelity Center for Applied Technology. And of course, we love acronyms. We're a big company, so we call it FCAT. But this group's mandate was to say, hey, Fidelity's been around for now over 75 years. Let's make sure we don't get disrupted or that we're looking out for the next big thing so we don't miss it, right? And so they started this in 1999, and their whole model is scan, try, and scale. And so they're scanning the horizon for these potential disruptors or things that might help us or create efficiencies in the company. So of course they found Bitcoin. I'm not exactly sure which year it popped up on their radar. Obviously this happened long before I was there, but a lot of this has been well documented and passed down. So hopefully I'm getting all the details right. But 2014, I know they had a pretty good group set up already, researching it, trying to find out as much as they could. And remember, back in 2014, there weren't near as many resources around. So they were already putting in the legwork to try to understand this. A year or so later, by 2015, this gets to that try part. They get their hands dirty, this group, FCAT. They don't just sit in their ivory tower, read about it, and talk about it. They actually do it. So they said, well, if we're going to understand this, we need to mine some Bitcoin ourselves. So they actually set up a unit to start mining Bitcoin. And of course, they said, we got to purchase a miner from China at the time. And so they put in an order for $200,000 worth of mining equipment. And this is kind of a famous story now. That order was rejected by a procurement team, whether it was on the cost basis or maybe some legal or risk issues, I don't know. But Abby Johnson, our CEO and chairman, she, as you said, she believed in this. She was a strong supporter. And she's told the story many times where she had to kind of walk down to people's office and say, look, it's 200 grand, we're doing this. And for those who don't know a big company like Fidelity, obviously 200 grand is not nothing, but in the relative basis of a company like this, that's not the biggest expense ever, right? And so she said, come on, just approve it, right? And so they got to work, they got mining Bitcoin. Marty, you mentioned also they experimented with using it as a payment mechanism. So they rolled out a little pilot where some employees were given a wallet and some Bitcoin, and they paid for their lunch down at the cafeteria in Bitcoin. This was 2017, I think. So you can imagine how that went when you didn't have Lightning where it is today. There was at least waiting of 10 minutes or more. When people wanted to return something, that caused a ton of issues. So that didn't go as well. And there's still a lot of people at Fidelity today that you can see them calculating like how much that salad would be worth today if they still held that Bitcoin in 2017. But back to the mining, they're mining Bitcoin. And then the next thing they encountered was, well, we've got this mined Bitcoin, we want to hold it. But there's no institutional grade, enterprise grade custody solution out there. Well, of course, Fidelity custodies and record keeps a lot of financial assets. So they said, why don't we just build our own? And that gets to the scale part of FCAT's mission, right? If there is a possibility to turn this into a product or to scale it out over Fidelity, then they're going to look to do that. And so in 2018, Fidelity Digital Assets was born, and our first product, and still our main core product today, is custody. So cold storage of digital assets. And then we've added services on top of that since then. So again, like you said, the whole point of the story is we're not just joining the bandwagon. We've been here a long, long time. I joined this role 2 years ago. I think Fidelity Digital Assets was around 100 employees, maybe maybe getting close to 150 at the most. Now today, 2 years later, we've got over 600 associates here. So there's been a lot of investment.
There's so many different ways to take this, but I think one of the thoughts or questions as you navigated that story and journey is, in my understanding, it was the greatest sense of example of innovator's dilemma of sitting in a room, and at least a story is, I understand it, like what can disrupt us or how can we disrupt ourselves? And it was this technology. And I would love to hear kind of like how you think about it right now, as far as integrating into the traditional financial system, because I would imagine we're still very early in understanding how this, could potentially disrupt financial services, but there's this world where you're starting to see it, you're seeing the interest, and you have an existing, whole book of business across, equities, bonds, across the board, about how Bitcoin's starting to seep into that. And then if you can, how you see it potentially disrupting some of that, if you have any theory or any stance on the side of Fidelity of where Bitcoin starts to insert itself in the Fidelity stack and then other, large institutions.
Yeah, great question. I mean, I know back when they were researching it, they made a list of all the ways this could potentially either integrate with the business, whether it's record keeping or stock transfers, all that kind of stuff, or whether it could disrupt it. So they've made that list. And I'm glad to see now at this stage, the focus, or at least what they've ended up doing by our actions, you can tell, is to first focus on Bitcoin, the asset, right, of getting people exposure to it. And of course, it started with Fidelity Digital Assets, the institutional side. Now you've seen us expand on the retail side with Fidelity Crypto. So any retail person, any of our millions of retail users who have a Fidelity account can get access as well. We custody the Bitcoin for them and other digital assets. Now, where it goes in the future, who knows? Who's to say? Obviously, we're still looking at a lot of potential things. But at this point, I think it was the right call to first get the custody thing figured out, because that is just so core. It's like a primitive to the whole financial system. And then from there, that's where you can build all these other things, even just like adding a service that we've added, that we added later, like lending capabilities, like all that stuff has to come after these really core fundamental things.
Yeah, and you're touching on an idea that I feel very strongly about, and it seems like Fidelity really grokked this early on, is that there's an order of operations to how Bitcoin will succeed and ultimately be integrated into our financial system, like starting out with mining first. Like I actually think that is the first order of operation, like mining in full nodes, making sure that that's sufficiently geographically distributed is the first thing. And then it's like, okay, we've plugged our miners in, we've received our Bitcoin for participating in global consensus. Now what do? We have to custody it. And then you just mentioned lending. I think that's the logical next step after that, is this order of operations. And now, sitting in 2023, there's robust mining, there's robust full node distribution, there's robust custody products, lending products are becoming more popular. We discussed Lightning impediments, they're further down the order of operations. But that's one thing that I believe strongly, is that there's this order of operations to things. And it seems like at Fidelity, you guys have honed in on that and really prioritized, like focusing on the first set of order of operations, perfecting that, and moving from there.
Yeah, absolutely. I'd agree. And from a research perspective, we try to do the same thing. It's like when I first came on, it's here's what we have so far in our research library. Where are the holes for someone going on this journey of understanding what it is, understanding the basic technical things, at least up to a level that an investor needs to, understanding the value proposition, understanding how it might fit into your portfolio, understanding how to manage the risk. That has an order of operations too. So we try to mirror that as well on the investment and education side.
Yeah, so I just can't help but think about how it's Fidelity is the only example that I can think of an institution that has gotten this far down the learning curve already with regard to Bitcoin and building products around it. As Michael mentioned, like with the innovator's dilemma in mind here of some of these products are changes for how traditional finance does things. Some of them might disrupt existing products. And I would love to hear it, if you can share a little bit about what you see as like the institutional learning process. And I know that you've been, only been a part of it for a couple of years here, but clearly there's success, because if you go from 150 on the team to 600 over the 2 years that you've been there, that's 4x growth, and Fidelity must see this as a major growth area. And would love to hear like what has that institutional learning process looked like, specifically in terms of how, what's ahead for other institutions that are only right now, maybe they're a couple of years into their learning process with regard to how they incorporate Bitcoin into their business models. And so what has that like institutional learning and then processes and teaming, and you talked about the experimental model, but what do you think have been some of the major lessons that Fidelity has gleaned, and with respect to like what's coming for other major financial institutions as they learn?
Yeah, I mean, a lot of things there. So even just in the 2 years I've been here, I've noticed with client conversations or prospective client conversations, their questions are getting a lot more sophisticated. So whether from our material or other material out there like that you and others have put out, they're getting the message. They're getting up the learning curve. And so it used to be a lot of what we'd call Bitcoin 101 stuff. What's Bitcoin? What's the difference between Bitcoin, the network, Bitcoin, the asset? Why is, most people didn't even know there was a cap, 21 million. Certainly didn't know about things like difficulty adjustment, all that kind of 101 stuff. And now it's become a lot more sophisticated. So the challenge is still people are all over the place. And even if you do like a group call or interview with someone, if you have more than one person, they're all on different levels. So that's always a challenge to try to speak to everyone in the audience. But overall, I think there is progress there, right? And so that's encouraging to see. And so people are taking it a lot more seriously. And we can talk about this as well, one of my theories, but the excuses or the roadblocks for people not doing it are also getting a little more sophisticated as well, for better or worse, right? And then for what's coming, I think a lot of institutions are realizing that this is different and you can't just jump in here. It takes years and years of preparation and work. And that's why Fidelity recognized this early, and why they've grown the team so much is because they obviously believe in the space. They obviously believe it's going to grow, and we want to be ready if or when it does, right? And so you can't turn on all of this stuff in the next bull market when people are asking for exposure. You've got to have it, all your ducks in a row, ready to go once that happens.
Yeah.
Okay.
Just to round that out, like I was thinking about how Fidelity stands in a small group in my mind of like kind of innovators, first through the door, sort of idea here of like it's Fidelity, it's Paul Tudor Jones for big name investors, MicroStrategy, and El Salvador. Like those are the people who were like clearly ahead and first through the door, and their experience is modeling for others whether or not it was a good idea, first of all, and then secondly how others can follow that path. And I think it's notable that for each of those four categories, they've all had a good experience. Like every big name investors, El Salvador is doing great in large part because of their adoption of Bitcoin. MicroStrategy has outperformed everybody on the stock market, and Fidelity is investing heavily in this new product area. And I think that that's part of connecting the dots for everyone else as they're evaluating, is it a good idea to touch Bitcoin, to get involved in Bitcoin? And it's proof positive when these leaders have a good experience and double down on their involvement in Bitcoin. So yeah, Michael, you go now.
Yeah, I was thinking it would be good maybe to take a step back, because I think it'll help in two parts, because it's fascinating. You walk through, Chris, like the not trajectory, but like starting from mining or even before mining and thinking about, how do we disrupt ourselves before we're disrupted, and thinking through that and having that like from a cultural lens, and then the mining, and then using it in the lunchroom and where you're at now, and all the things that are planned for as Bitcoin grows. You guys manage close to $12 trillion in assets. Like, to have that culture and go through that is insanely impressive. The only company I've been at that has had some of that embodied is Google, 100,000 plus person company, and you can get up and pick up and do things, and you expect that. I don't know if it's still like that, but I think it's important to understand the ethos of Fidelity and how like that was even possible, because to Jesse's point, I think that there's different areas of the market, whether it's the Michael Saylors, the El Salvadors, they all have their own overlap with something that exists at Fidelity, and then they also have their own like particular instance that we're going to start seeing with other countries, with other financial institutions, with other Fortune 500 companies. And so I think by understanding more, just because it's fascinating what made Fidelity do this, but then also we can start to look at who will be the incumbents that also adopt this, and then who will be the ones that don't. Because we've seen this the past couple of years in the cycles, is like people touch it, and then the market falls, and it's like, oh, I'm done with it. Like you keep hearing. I think the latest was I don't know if it was TD, but there was one firm that was like, oh, we're going to scrap our digital asset strategy. And then they didn't really have that confidence and conviction of understanding what's happening here. So I would love to just hear about the culture of Fidelity and like how, you see it from coming in, of like, it was in the ethos to look at this, if you don't mind sharing.
Yeah, no, that's a great question. One that attracted me again to Fidelity in this position, which it was very clear that people truly believed in it. And on the research side, I like to tell my team, it's a little cliche, of course, but we have a missionary mindset, not a mercenary mindset, right? So our research is stuff we truly believe in. And not to say we get it all right or anything like that, but we're not here to try to make a quick sale or something like that. And our business model is aligned with that, right? As a custodian, you make money off of the fees of custodying the assets. So our goal is for people to understand the core value propositions of Bitcoin and digital assets, and to have an allocation and an exposure to it, and have a very long-term allocation and time horizon. So that aligns everything, right? It aligns what we think is the best way to play this and to get exposure to it. It aligns what we think is the highest chance of probability of success the longer you hold this, a long-term view. And then it aligns with our business model of how we make money, right? So we don't make money off of tons of trades like other companies out there, and we're not only crypto, we're Fidelity. So even if people come in through the digital asset side, then they might, access or want other services from Fidelity. In terms of the culture, I mean, I'm not sure exactly where that came from, other than, some certain people that really believed in it and carried the torch. But to your point of such a large company being able to do this, I credit that with the structure that they set up with us as being a subsidiary. So people have likened it to more of a startup feel or late startup feel, yet we have kind of the guardrails or the safety net of the Fidelity parent company above us, which is a really unique and nice structure to have, quite frankly.
Yep. Yeah, there's this term I didn't necessarily had heard before, but I kind of recognized it over the years, and being in this space is like an educated client is a great client, because we're still so early in this whole period of understanding Bitcoin and custody. And it's like, if they understand fundamentally what's happening, they can think about it from a long-term time horizon. You can provide the right products, and they can be long-term clients. But we've seen, again, over these cycles coming in, there's only so many people available to educate, to really break things down to first principles and embody, or be able to facilitate that. You mentioned Jesse's content and for the research, it's like over these years, the signal is getting tighter and tighter, and the education information becomes quicker and quicker to go from, well, what is this, to, oh, maybe this is something that I want long-term exposure to. But we've just gone through these phases year after year of there are some entities or people that come into the space that aren't able to pick all of that up. And so that's where we see a lot of the, I think the past 24 months have been very volatile and they've been, great for certain aspects. I imagine they've been great for Fidelity because they anchor back to fundamentals and to the type of clients you're looking to attract. But on the other side of that, a lot of people, I think the past few years have gotten burned because they weren't educated properly. And the businesses that didn't educate them as well weren't able to really kind of reap the rewards long term because the client didn't fundamentally have an anchor into what's happening. And ultimately, this is, I don't know if you agree, but we kind of like joke around. It's like alien technology. This stuff is not easy, especially when you come from a traditional finance background, to look at it and understand fixed supply and something that could have value. So it really isn't easy to educate.
Well, and to piggyback on that, I guess a good topic to dive into is, having written these research reports over the course of many years, what have you found has connected with your clients and really help them grok what's going on here with Bitcoin? What type of information do you find is the most high leverage in having the light switch go off for your clients?
Yeah, great question. So in terms of the type of content, really the educational stuff, and knowing that we talk to institutional investors, anytime I can bridge this digital asset world back to the traditional finance world is usually helpful or a win. I was in that world, got my CFA, all that kind of stuff. So I can speak their language, right? And so if you can put things, even though they're not always great analogies or ways of putting it, sometimes if you put things in their terms, like, well, this is kind of like a PE ratio or whatever the example might be, then you might see them pick that up, right? The other thing I found is whenever we talk to a client or prospective client especially, is I try to feel where they are on the macro thesis, right? Because that kind of then determines which path to go with them. And what I mean by that is, are they already on board with some of the big macro themes that we've identified in our research? And you obviously talk lots about just the basic idea of currency debasement. IMF and others have papers out there saying this is the playbook, like this is how you take care of high debt loads. The fact that our debt to GDP is very high, we've got huge structural deficits right now. If they're on board with that macro thesis and they already hold that, then it's a lot easier in many ways, as you can imagine. Then it's more talking about the intricacies of the technicalities of Bitcoin and some of the unique investment characteristics, but they're on board with the big picture. If they're not on board with that, if they just see it as you're a gold bug or something like that, and they're just vehemently against gold, for whatever reason, good or bad, then it's a different approach. Then you got to try to say, okay, is there a chance you could be wrong here? Or wouldn't you even just want to hold kind of a market neutral position of Bitcoin as a percent of the total global investable universe? Or maybe you can do the technology play with them, like kind of owning the next piece of the infrastructure of the internet. Sometimes that narrative or thesis works as well. But that's a different conversation, if that makes sense.
Yeah, you're hitting on how in our conversations with folks and on the podcast last week, this was a major theme, is it's hard to put this asset in any particular bucket. It doesn't fit in portfolios the way that portfolios have traditionally been constructed. And so I think you're sort of speaking to that, but I guess, where do you tend to see folks fitting Bitcoin into their portfolios? Do they, in your experience, do they tend to carve it out as like part of a hard asset bucket sitting alongside gold? Or is it like a technology play in order to hold a part of the internet of value? How do you see that playing out?
Yeah, great question, because this is actually a question we ask on our annual survey every year. So we are now in our 5th survey in process, institutional investor survey of digital assets. So this is one of the largest surveys done out there, over 1,000 participants, and everyone's always looking forward to next year's results. So stay tuned for that one. We're almost done or finishing up this year's. But one of the question is, what do you consider it? Do you consider it as part of your real asset sleeve or your equity kind of risk one, or do you take it out of bonds? And I don't have the numbers in front of me right now, but I think if I'm remembering correctly, most people carve it out as separate or as part of their real assets, right? Which makes sense because it's commodity-like, it's scarce. I think that resonates the most with them. And so we've also done a lot of studies showing if you had just say a 60-40 portfolio and you took it out of your risk bucket or your not off risk bucket, your bonds, it's what you would expect, right? You're gonna lower your volatility and returns or you won't lower your returns, but you're gonna lower your volatility if you take it out of your risk bucket, and then you're gonna increase if you take it out of your bond bucket. So it doesn't really matter, or people could just go half and half if they wanted to. But it really depends on kind of their mandate and how they view risk to begin with, if that makes sense.
Right. And is part of that, it doesn't really matter which bucket you take it from, ultimately, because Bitcoin dwarfs either of those buckets. And so whichever bucket it's coming from is a good bucket to be taking from.
Yeah, exactly. I mean, if you're purely looking at historical numbers, which have been through the roof on almost every time frame, then yeah, it trounces everything. So, I mean, theoretically, if you have no risk limit, then it's like you would just allocate everything to it purely on a backwards looking historical basis. But yes, you're right.
I'm sure you found that BlackRock report rather eyebrow raising when they concluded the optimum allocation was 87% or something.
Yeah, I wanted to say 90%. I read that paper as well.
Well, it's funny because I actually got dinner with somebody on Monday night who's in the space and is working on a credit-related Bitcoin product, and their team has ran the numbers on the worst 4-year CAGR return of Bitcoin. And it just so happened to be April 2019 to April 2023. So recently, and the CAGR in that time period was 23.4% or something like that, which is unheard of in any other asset class.
Right. To do a shameless plug for one of our pieces, this is the exact problem we tried to tackle in one of them. It's something called Bitcoin, using machine learning to model Bitcoin in a portfolio. And so here we tapped another team at Fidelity that works with these machine learning AI driven models. And they looked at this problem just from a quant perspective, saying the history of Bitcoin is short, especially if you only go back to like when you have some, pretty solid trading data, it's very early days. And furthermore, not only is the history short, but it's crazy good, right? So if you don't think it's going to repeat that, how can we really model that forward? And so they use some sophisticated techniques, which I'll be honest, some of them are over my head, to try to create some synthetic returns or data looking forward. But basically they model it like a very high growth, high tech stock, high beta stock that has, huge skews in terms of their return distributions. It's highly skewed to the right. And so they say, if we can do this with some stocks, why don't we just say Bitcoin is going to be similar to that and then work off of that? And not surprisingly, it all depends on your inputs. But if you think Bitcoin's going to return more than your current asset class buckets, then it makes sense to put a little bit in your portfolio. And how much you put in is, of course, just dependent then on how much you're willing to lose. And kind of the unique thing they did with this is, instead of the efficient frontier, which the nerds listening will know what I'm talking about, the efficient portfolio efficient frontier, they did something called an efficient loss frontier or something like that, basically saying, how much are you willing to stomach as a drawdown? And then from there, you can decide your allocation of Bitcoin, right? Because that's the true measure a lot of people care about. How much how much loss can I get? Not necessarily how much gain can I get. So yeah, we can put a link to that in the show notes or whatever, but that was one of the ways we tried to tackle this, but it's a sticky problem for sure.
Does that come up in the conversation, like the fundamentals? Because I think that, like you're kind of alluding to, I think, for certain people interested, they've kind of jumped the gap that there might be some value here. But for others, and I think the majority, it's like there's a lot of error between $0 and $26,000 or wherever you're at. And obviously on this call, and folks listening know about, hash rate, addresses, all the things that are the fundamental underpinnings of what's happening. But does that come up, and have you guys constructed anything around that to show like there's fundamental growth across almost every metric in the ecosystem when it comes to Bitcoin?
Yeah, that's a big one we like to hit in our recaps and roundups and updates. We like to say, look, if you removed price and you didn't know what the price was, and we just gave you the network fundamentals, you'd be surprised we're in a 60, 70, 80% bear market or whatever it is, because all of these metrics keep going up. Another research product we did this year is something called the signals report, where there's all these signals out there. There's your traditional price signals, and then there's all these specific on-chain signals to Bitcoin, as you know. And institutional investors, they might know about it, but they don't know how to correctly interpret it or place it. And so what we did with this report is we put them in buckets. We said, identify whether you're a short-term, medium-term, or long-term investor. And then depending on that, here's the signals you should be watching. And so for the long-term, the investor persona for that one we say is, I'm a long-term investor, 10 plus years. Maybe I'm DCAing every month or quarter, whatever it is. All I care is about the absolute fundamental thesis. And the absolute fundamental thesis is this thing going to survive, or is it going to die, or people are going to become apathetic about it? And so really the only signals you should care about are these long-term things like hash rate, address growth, transactions, all that stuff that you guys know. So that's one way we've tried to also approach this problem with people.
That's such incredible framing and positioning of like, let's just put the price aside and let's look at this over the course of X number of time frames and say, like, you wouldn't know what the price, you wouldn't know that we're sitting at $27,000 right now.
And ultimately, you're right. It's a binary question, an outcome. This thing either works and becomes digital gold and more, or it doesn't work and it goes to zero. So the digital gold would be 500,000 per Bitcoin, and so a 20x from where we're at. Everyone's very happy if that happens over 2 decades. Even that's a fantastic outcome. Or it goes to zero, and we are all wrong for some reason that after years of digging into it, and lots of brain cycles spent looking at this thing, we are missing something. And so you're right that like on the long time scale, that's all that matters is adoption increasing, because adoption increasing interacts with the finite supply of this thing to cause each unit of supply to become more valued over time because more people are competing for it. It really is that binary in the end, isn't it?
Yeah, well,
and what you've hit on here is another approach we use with investors, institutional investors, which is they understand things with asymmetric payoffs, right? And so that's one we hit, just like you said. I'm in your camp personally. I think this is pretty binary, especially over the long term. It's either going way up or it's going to basically nothing or staying kind of nowhere, right? And so if you believe that, then why not have exposure to something so asymmetric? Like that is the big holy grail in finance, finding asymmetric bets. Like that is how alpha is created. And so that really resonates with institutional clients as well.
Yeah, and on this note too, I think a topic we should bring into this, bringing the price back into it. I think that's one thing that the Bitcoin price volatility has really proven out over the first 15 years of Bitcoin's existence, is that time in the market is way more important than timing the market. And trying to articulate that to new investors is kind of hard, because when we go through these bull cycles, it's typically like 2 to 3 months where we run up pretty crazy and then it crashes back down, and that's all they see. They're like, oh, this is way too volatile for me. But you can run the numbers. Historically, if you spend a lot of time in this market, your portfolio is going to benefit massively. And just trying to articulate that to people gets a bit muddied with the high volatility rate that's existed historically.
Yeah, the volatility keeps coming up. If you look at our survey, it's usually the number one reason listed why people don't invest. And frankly, I don't quite understand that from institutional investors, because these investors should know volatility is never a reason to just not invest at all. It's a reason to make sure you're appropriately sizing your position, right? That's the key. And they should really know that. So I always push back and say, oh, it's too volatile. So do you own any Netflix in your accounts? Because Netflix has had drawdowns of 80% or more 3 or 4 times now as well in its history. And I'm not picking on Netflix. It's just an example that that's what you can experience with other assets you already invest in. So are those completely off the table? No, you just make sure you're appropriately sizing your position and your risk.
Yeah, and it goes back to framing like volatility as opportunity.
Mm-hmm.
And you alluded to earlier how there are increasingly sophisticated objections to Bitcoin, because change is difficult. I think is really what it comes back to, right? And for TradFi to have to reckon with, like, why is this thing that, on, based on my mental model of how the world works and how finance works, this thing shouldn't exist or shouldn't go anywhere. It should be a bubble. Why is it continuing to have little mini bubbles with higher highs and higher lows every 4 years, and not going away, and in fact continuing further into an adoption curve? That creates the basis for people wanting to find sophisticated reasons to not have to incorporate this into their portfolios and into their models about where the world and where finance is tracking currently. And so I want to go back to, I can't resist asking if Fidelity has, when you went to the quant team and they modeled out, their perspective of volatility going forward with Bitcoin. Does Fidelity subscribe to the idea that the halvings matter, or is it a liquidity-driven price chart, or what can you talk about there?
Sure. So I just a quick note, when we say like Fidelity, we're not talking Fidelity as a whole. We don't have a house view on these things. Right. So I'll speak from Fidelity Digital Assets and our research team in particular, but we certainly think the halving is worth watching. And it has to have some effect, because you're changing the two most important things in economics: supply, the other one being demand, right? So my colleague on the team, Danielle Gray, actually has a piece out not too long ago, a couple months ago, going into the halving and basics of what it is, but then also doing analysis of, well, if past is prelude to the future, what could we see, or how could this play out? So we're still debating internally as well, though. The jury's still out, because we haven't had a real world example of whether the halving is the primary driver, or whether it's just happened to match up with these 4-year liquidity cycles and Fed cycles, as you know, or maybe it's both. Maybe we'll see these two things happen differently this time, or maybe they'll happen together again, and the world may never know which one's the primary driver. But I think, just from a first principles perspective, if you go through the economics of the supply and the demand and what happens with the halving, it has to have some effect. But of course, people can debate how much of an effect it has. But it's definitely something that people should not be not aware or ignorant of, and should be watching carefully.
Yeah, it'll be really interesting to see if the Fed is able to keep rates elevated for another year, and what the Bitcoin price does in that type of environment post-halving next year.
Yeah. I have the luxury of being able to fly off the handle and say, I don't think it's going to happen.
I don't think that's too far off the handle, Jesse.
No, that's true.
But with all that in mind, I mean, because there's a social aspect to it here as well. Obviously, you have the supply and demand with the halvings, and then you have the liquidity of the incumbent system driven by Fed policy. That's always something that's lingered in my head. Like, if Fidelity is successful in convincing other institutions, and it doesn't have to be Fidelity by themselves, but other institutions, have the light switch go off, and then there's a psychological, social aspect of it that could happen at some point in the future as well, where, yes, the halving may have somewhat of an effect, liquidity profile of the monetary system may have some effect, but is that psychological light switch going off for a bunch of institutions at the same time? Does that have like a more profound effect at some point in the future? People just flooding
absolutely. I think as much as we like to paint the finance world as quant driven, and it's obviously gotten a lot more quant driven in the past few years, I personally believe, and I've been in the space long enough to know, that it's still humans and it's still people making these decisions and pulling these triggers. So don't underestimate that, and don't underestimate the reflexivity of something like that.
Yeah, and let's dig deeper in that, because I know, Marty, when you kicked off the show, you referenced Deutsche Bank, but we're getting like ink backwards from Deutsche Bank was, I think, today, a few days ago, Franklin Templeton, I think a 1.2 trillion plus in AUM filing for ETF. We've had this drumbeat of institutional kind of activity happening this year. And in my opinion, it feels like it's the first year that institutions are trying to front run the halving. Like, to your point, that we had the cycle and everybody went into hibernation, but they were working on stuff. It wasn't like they were like, oh, this isn't coming back. And now there's a lot of stuff happening in the quote unquote digital asset space. But I think preparing for, but staying on Bitcoin, how are you kind of seeing the market as far as just like institutions building infrastructure, thinking about this next wave of adoption? Because I think it's probably, for anybody that's paying attention in the space, it's not going away, and there's probably another cycle happening. And so now they're again from this vantage point, like preparing to absorb that flow. And I don't know if we've seen that in previous cycles ahead of a halving. Thinking back even just like 2019, I think people initially still thought that like halving didn't matter. I think most people would come in. I think the reasons why the halving matters is still up for debate. And there's efficient market hypothesis and a bunch of other things that people will discuss. But yeah, just curious, Chris, like how you're seeing it and how you guys are preparing. I know there's some products you guys are working on, the fact, whatever you can share, but then also just from the external market and what you're hearing and seeing, feels like a lot of institutions are getting suited or prepared for whatever's to come the next couple of years.
Yeah, absolutely. I mean, I don't know if institutions are internalizing the halving as that much. I guess I just haven't heard it anecdotally, but whether or not they are doing that or just subconsciously or through other means and signals and data, I do agree with you that they are now fully on board of thinking this is not going away. And so that's why you see all these announcements of institutions with coming out with this product or preparing with this or ramping up that. And so they're coming along and they're incentivized to do it, right? If there's potential for money to be made and to serve their customers, they're going to do it. And so they don't even have to necessarily fully believe in the halving or Bitcoin itself. And not to take this on a different note, but just because it reminded me right now, I was listening to your previous episode with, I think it was Lauren, and he was saying something like, well, the institutions are coming, but it's just slow and gradual. And I would agree it's currently slow and gradual, but he seemed to say, not to put words in his mouth, that it might just keep going slowly and gradually. And my experience in the industry, I personally think there's going to be a gradually then suddenly kind of event, a turning point. And the reason I think that is because of two things. One, in the institutional money space, if you're a money manager, whether it's of a family office or hedge fund or a big endowment or pension, whatever it is, almost all of these people have a benchmark that they're measured against, right? And so just Bitcoin itself today, Jesse, you've run the numbers probably more recently than me on this, and I saw in one of your articles, but out of the global investable universe, we've come up with like 0.2 to 0.5%, right? So it's hardly enough to warrant being in one of these benchmarks. But if or when it gets big enough, or when it's just added because it's a different asset class and these index providers add it, that gets added to all these money manager scorecards. And so I used to be at a money manager in Chicago. It was a $10 billion growth fund. I worked on a team, and I was the low man on the totem pole early in my career. And one of the things I had to do was prepare these attribution reports. And so every month and every quarter, I'd give my manager this attribution report, and it said, here's how much you outperformed your benchmark, and here's why you under or outperformed it. And it would go by sector and by even industry and specific stocks. So you were underweight this stock or this sector compared to the benchmark, and it did really well, so that hurt you. So what happens when all these managers start getting their attribution reports saying you underperformed your benchmark by 200 basis points, 2%, which in finance world is a lot for people who don't know, because you were underweight Bitcoin. And the other thing this reminds me of too is early in my career, we were on the growth fund, and there was some stock, it doesn't matter the actual name, if it was Apple or something, it was doing really well, and it got to be a big position, like 5% of the benchmark. And some of these managers are like, well, 5%, that's a big position for a fund. Like that's where our upper risk limits are. So we have to own 5% just to be neutral. And it's like, yeah, if you own anything less than 5%, you don't even have to have an opinion on it. But if you own 0% of something and the benchmark's at 5, you're effectively underweight that thing by 5%. And if it does well, it's going to hurt you. So if you have no opinion whatsoever, if you're completely neutral on Bitcoin, and let's say it's in your benchmark at 2%, then you have to own 2% of it. Otherwise, you're taking an active bet for or against it. And then, of course, all the passive managers out there will just have to own it as well, right? So that's one of my personal reasons why I think you could see a flip, like a big turning point. And the other big thing is just the whole idea of career risk. So in the finance world, career risk is everything. If you underperform due to something, but all your peers underperform because they were also getting it wrong, it doesn't hurt you as much as if you stick your neck out on something and it turns out to be wrong, right? It's career suicide. So as soon as that career risk goes away and everybody is kind of owning it and doing it, then that's also when you'll see a big acceleration.
Yeah, I think it's so interesting how a big element of the adoption curve is human psychology. And that manifests in a variety of layers. And career risk is a big part of it, particularly with regard to institutional capital allocators or money managers. And you're right that Bitcoin's entire history to date has been as an asset that doesn't move the needle. It doesn't matter in terms of the global asset landscape. It is, by my estimations, 0.5%, as you said. So 1/2000th of the world's value is in Bitcoin. So you can ignore that and that bucket, that tiny little thimble, and you're fine in terms of tracking the overall asset landscape and on a weighted basis. You're going to be fine if you ignore that. But there's some threshold where that's no longer true, and then that introduces this issue of career risk, which is really a kind of pressurized version of social proofing. That Paul Tudor Jones says it's a good idea. Bill Miller's on board. Stan Druckenmiller, now Larry Fink, Ray Dalio is sort of opening up to it. So why aren't you, hedge fund manager, participating in this thing? Are you gonna miss out on another year of Bitcoin being the top performing asset in the global asset landscape, which has happened 10 times or 11 times out of the last 14 years? And we're due for another 3-year run, in my opinion. And so that element of human psychology is really what drives the adoption curve, because the next incremental slice of adopters is motivated by all of the inputs that they're gathering and how their psychology processes whether or not it's time to make the jump. And that's a push and a pull system, right? Where you're pulled in because you find the potential upside very attractive, or you're compelled by the fact that bonds are probably going to lose, are going to be a losing proposition on a real return basis over the coming decade or two. You might be pulled into Bitcoin, but you can also be pushed into Bitcoin because you have to include it in your portfolio because you might fall behind versus your cohort that you're being compared to if you're managing money. Or you might fall behind your neighbor or your friend who has a little bit of Bitcoin and you're sick of them outperforming you. And so the adoption curve is really this manifestation of human psychology. And that's why ultimately it's a bell curve, because that's how human psychology plays out in a smooth distribution of how each of us with our individual circumstances and faculties process reality and change our behavior in a distribution manner. And we are still at the very early stages of that, and we're going into an increasing, towards the middle of the bell curve where all of the crazy action happens.
Chris, that topic you went to is insanely fascinating on the benchmarks and underperforming. Can you talk about how you see, and it doesn't have to be relative, and it can be if you feel comfortable discussing plans on the wealth management side, but I feel like there's something very similar with RIAs and financial advisors. And I think I was listening to one of the, I think it was a webinar podcast that Jack on your team did with Tyrone Ross and a few other folks about, I forget the number, but I think it's like anywhere between 70 to 80% of like Bitcoin crypto sits outside of FA wealth managers platforms because of a number of things, whether it's like, career risk, the tooling and all the things associated. But how do you see that playing out? Because it feels like a very similar dynamic of there's going to be certain benchmarks that are going to become more and more visible. And that individual, as we know, inflation runs and Jesse's point about bonds, that it's going to get harder and harder to keep pace on that storing value long term in a world where the cost of goods is increasing. How you see that playing, because there's trillions and trillions sitting in those accounts as well, outside of traditional kind of pensions, hedge funds, endowments.
Yeah, absolutely. Yeah, on the wealth side, the RIA, that sort of side, it gets to Jesse's point about the push versus the pull. And in that segment, it's the end clients who are doing this and trying to usually push the advisor to either accept it or help them custody it or manage it. It's not the advisor pushing them saying you should own a certain percentage. So that hasn't flipped yet. And maybe it will in the future. I could see that as a possibility, of course, when advisors all kind of get on board and get the message and become believers. But so far, it's still the individual torchbearers who have their coins somewhere off of their advisor's platform. They've done it on their own. And that's why you have that big number that you just mentioned. And so, that's one thing Fidelity's focused on with, you've seen some news around our WealthScape offering, for example. This is a platform for RIAs and similar broker dealers or family institutions, allowing them to get exposure through this workflow in this platform that they already have, right? So that allows the advisor to handle it directly. And then, of course, the services are done on our end on the Fidelity Digital Asset side of the actual execution and custodying of the assets. And then, of course, it's all built into the workflow with tax reporting and performance reporting and all that. So it's coming. It's very, this is very small at first, just a few people, and then we'll see where it goes from here. But I think that's a big deal in terms of normalizing it, right? Or maybe normalizing isn't the right word, but like building the normal infrastructure around it, like the infrastructure that people are already comfortable in the traditional finance world, then it comes here, rather than a client saying, hey, I've got Bitcoin in cold storage, I have the private key, what should I do? Should I give my advisor one key of a multi-sig or it gets a little, you can do that, of course, as you know, but it gets a little more complicated and beyond what a lot of people are comfortable with, especially advisors. If they're not trained or well-versed in the technical aspects of all of this, it can be really scary. So yeah, it's definitely coming, but it's still being pushed from the other end, not from the advisor end. But in the future, maybe if that becomes kind of the standard recommended, how advisors already kind of have these broad guidelines that a lot of them agree on, whether they come from their own companies or from CFA Institute or, all these other kind of things. I could see that happening in the future for sure.
Well, and that's what's like, just one thing on that rounding is you mentioned the gradually and suddenly, and Jesse was referencing the human psychology. And that is where I would double down on the gradually and suddenly on the advisor side when they start, because we know this whole system is all about aligning incentives. And I don't know the exact numbers, but it's, let's call it roughly 50% of advisors are tied to percentage-based fees to the AUM. And what better asset to juice AUM than Bitcoin once you catch it? And so now you're going from, I need to be, it's like pulling teeth to let my advisor hold this, to like, oh no, you should have a 2% allocation because I know what this thing actually does. And that's another gradually and suddenly of like when that flips, because that's money directly in the pocketbook of the advisor, wealth manager, RA firm.
Yeah. And before we get too far ahead of ourselves here, because I agree with all this, these switches are going to go off. We're going to have the gradually then suddenly moment. But I think to have a sober conversation about the state of the literal onboarding, the on-ramping infrastructure that exists today, we've seen that historically, particularly during the peak of bull runs, where many people are trying to get into Bitcoin, but the literal infrastructure that is getting people access to Bitcoin begins to break down. Coinbase, most notably, just breaks during these bull markets when the price is running. And Chris, you mentioned you guys have grown your team on the research side fourfold over the last 2 years, but just looking at the landscape of literal onboarding infrastructure, whether it be custody, OTC desk, liquidity providers, like what is the state of that part of the industry, and can it actually handle a massive inflow like the one that we're describing here?
Yeah, I mean, I can't speak for the rest of the industry. I mean, I can say from what I see at Fidelity, I would certainly think so and hope so. And this is where, the benefit of a Fidelity comes into play. A lot of times we get asked, well, why should we go with Fidelity, or what's your competitive advantage when you're this firm that's over 75 years old? And there's other crypto native firms who know this space inside and out because that's all they do. And there's some truth to that, of course. But the flip side is, yeah, we've been in the financial space for over 75 years. So we've got down pat things like risk, onboarding, operational controls. We've got a whole cybersecurity team. So this is where the big parent Fidelity company can leverage a lot of the stuff that we've honed and perfected over the years and just apply it to the space. So some things are the same. Bitcoin's very different as an asset in many ways, but as a financial asset and something to custody and onboard people, there's a lot of similarities. And so that's where things get leveraged across the entire organization.
Yeah, and I'd go as far as say is we'll never really get that one down pat until we reach a stabilization. Just being, building like infrastructure in the middle of these bull runs, they're so reflexive that I remember, like on the hardware device manufacturers, one example, they just like run out, right? Because the capacity, and we talk about like Coinbase being able to support on the onboarding, managing consultations, setups, like there's just it's a lot, because you basically, it's just so reflexive that and then you expand and then it contracts. So I think we're probably a cycle or two, and some kind of volatility being muted where you kind of have a better baseline or model for the growth trajectory. But yeah, so I think just to your direct question, Marty, I think we particularly end up in this push pull for the next like decade. Just given adoption.
And I think that continues until we've, I think this is an S curve, and it continues until we've gotten to the middle of the bell curve, which would be the mid inflection point there in the middle of the S curve. Which is to say, it's on the way there, it's gradually, but it's exponentially. So, rather than gradually, then suddenly, or gradually overall, as Lauren last week sort of advocated, I think it's gradually, but exponentially, in an exponential fashion. So, and I think that the way that this manifests is, I've used the analogy before of like Bitcoin, the infrastructure for the Bitcoin network grows the way that a tree grows, where, in the summertime when things are good, in the bull markets, the tree ring expands, and then in the bear market, it hardens, right? You go through that hardening process and on to the next cycle. But through that cyclical process of expansion and then hardening and then expansion again, it's not a smooth process, but it's an incremental, layered process of becoming a more robust infrastructure, and the network can onboard an increasing amount of capital and people because of the investments that happen during the bear markets. Frankly, the hardening that happens then, in order to support the expansion cycle that's coming in the next bull market.
And to get meta, like I don't think anything. I was just about to get meta. Yeah, well, so maybe we both get meta. It's like it's not really anything unique. We're just seeing these accelerated, right? If you think about like Bitcoin's just a microcosm. We talk about like the asset being the canary in the coal mine with global markets, and when liquidity gets sucked, it's the first thing down. We chatted last week. The railroads, fiber, probably like internet server infrastructure. Like you just always overexpand, but it's just over a longer period, so you don't feel it. And then you kind of build in that contraction when it's quieter and you have all this like oversupply, over capital in the space. And then you come back and it's ready for that next wave when it's prepared. So I feel like what we're talking about here, we're just seeing it in like real time because of the value and the prices, like tracking it and all the things and the people going to zero or happening faster. But it's probably the same we've seen over the past hundreds of years.
Yeah. And I was going to say, it sort of works out on a fractal. Like you see it not only with the industry, with the onboarding infrastructure, but you see it at the protocol level too. Like when the price runs, everybody wants Bitcoin. You have fees go up. You have to wait longer and longer for your transaction to get confirmed at the protocol level. We hit that limit and people say, oh, this doesn't work. And that provides a data point like, all right, here's where the outer edges of the network are, and here's what we need to fix on. That's why we get things like SegWit, Schnorr, Taproot, Lightning, Fedimint. Like there's just, it's like Bitcoin is this living organism in these adoption waves. It gets pushed to its limits. We figure out where the limits are at the protocol level and the layers above. And we're like, all right, here's where we hit the limits this time around. Let's make sure that we can go beyond those limits during the next cycle. And then you see that happening in parallel with the industry too, with the businesses that are servicing the new Bitcoin users.
Yeah, this is a really great topic to discuss because I think it helps in a way provide, we talked about the layer between 0 and 26,000, but we're actually discussing real time, like for individuals looking at this, well, why is there that volatility? And we're describing in real time. And one of the other analogies that's used in the industry is like gold monetizing. We're watching it from somebody picking up as a like rock and dust it off and shave it and pull it out of the earth and put it in a coinage and stamping it and turning it into something that's used for food or whatever is needed. We're just seeing that play out in real time, and we're somewhere in on that curve of it being something somebody's pulling out of the earth and then it being used as a unit of account to buy a building or whatever that might be. And so that period in between is very volatile. And we just happen to be watching it.
Yeah, and on the research side, we actually have mapped that out before, and other people have done this too. And I'm usually not a fan of mapping different time frames, axes over each other. But just as I think a illustrative example is, you can look at when we went off the gold standard and then it was legal once again for people to invest in gold. Gold had to go through its own monetization phase, right? And people had to recognize what it was, that it was an investable asset class now. It wasn't just fixed at $32 or $34 an ounce. It went through this massive boom up to 800, which in percentage terms was crazy. It had a big crash down once again. And now, it's kind of going through another big adoption phase. So that's one proxy we've looked at. We had someone on our, not on our research team, but within Fidelity Digital Assets, he had a lot of experience in the commodity markets when they kind of became an investable asset class. And so there's a piece out on our website of how that went through the financialization and the productization of people being able to invest in commodities as an investable asset class. And we've seen the same thing with Bitcoin. There's similar markers there too. Michael, one thing you said earlier reminded me, you said how railroads or fiber optic went through these big booms and overexpansions. And I don't know if any of you have read that Perez book, the economist Carlotta, I think is her first name, Financial Capital and Technological Booms in Financial Capital, or something like that, if I'm getting that right. Do you guys know which one I'm talking about?
I haven't read it, but I'm familiar with it, yes.
Yeah, she has a few, right? There's another one that's like the innovation cycles. That's, I think, was before it. Yeah,
so she wrote this many years ago, and a lot of people in the space have picked it up, and that's how I heard about it, saying, look, this is kind of like what's happening with Bitcoin, where she takes really broad stretches of history, like the railroad boom or microprocessors or something like that. And she shows through her it's an academic book, that financial capital and technological capital have to go together, and they feed off of each other. Or at least this is what I've gained from the book. Our whole research team read it together and discussed it. It was a lot of fun to see the similarities. But her point was, there's definite phases of speculative financial boom where everyone piles in and the finance side gets ahead of everything. But then that's what also funds a lot of the stuff for the real tech or the real productivity enhancing stuff like railroads or microprocessors. And so you need both of these things to feed off of each other, but they kind of move in different phases. And so we also tried to match where we might be in the current cycle. And it's easy to say like, oh, we already had the big frenzy, the boom, like the ICO boom. Oh, and then the recent boom to 69. And my point from the book was, these things are so large that they permeate almost everything in society. Like if you think of how railroads dropped the price of so many goods, or how microprocessors affected everything. To me, if I read the book and I try to match it up to our current cycle, we're not anywhere near there yet, because Bitcoin and digital assets have not permeated all other industries. They have not shaped and changed all other industries in the whole capital production cycle yet. And so it's an interesting read. She's actually been on Twitter saying, don't apply my book to Bitcoin, which I think is funny, but we did anyway. So
that's such a good point, Chris. It's such a good point. I think it's also where this like pod comes in. It's because there's a lot of, value and I don't know if money to be made, but I guess money to be made if you're right about some of this stuff. And there's a lot of money that will be lost. And I think, when you reference some of these technological cycles, somebody has to go through the door, and, that's their capital that went out. I think it just doesn't, we talk about being a microcosm or being faster. There's just a lot more money to be lost faster in this environment, because it's basically you're spinning up, units that are tied potentially to money, and people are putting their money or investing. And so I think basically saying like there's a lot of information out there, and finding the right anchor points to get through the fundamentals is paramount, more than anything I could probably imagine, because it's just so easy to put the dollars to waste in something like this. And we've seen this in the past 15 years versus kind of something that's hard infrastructure. There's still scammers out there and there's still noise, but I feel like this is the tightest version of that. Because you're basically taking your dollars for something that can basically go to zero and is a click of a button away. So there's no question there. It was more of just like it was dancing around the topic of, it's just like do your diligence and do your research when if you're coming to the space and looking at like what could be the next big boom, or how can you create value. It's that it's a little bit different in that way, right? That there's not a lot of opportunity. There's not a lot of fixed cost to creating a cryptocurrency, and so it's really important to understand the underline and why there's value around Bitcoin.
Yeah, it comes back to that, like, for these previous technology waves, the railroads or maybe it's microprocessors, there's hard assets there. There's tangible assets that you're investing in when you're providing capital for something like that. You're investing in a railroad, and there's proof of work because there's either a railroad built or not. Same for like a chip manufacturing plant. You know what you're getting. But when it comes to money, there's this. It's ephemeral. It's an idea. Ultimately, it is what everybody decides to structure their finances around, and that is a shifting target. It's an intangible target, and so it's easy to be misled. And it's easy to fall into the traps. There's always been snake oil, and like the American West is a great example of, like, that's where the term comes from, because snake oil would pop up as the hot new product that you had to invest in, and you don't want to miss out on the next Coca-Cola or whatever. And next thing you know, you've purchased a stake in a business that is hot air, and that's even more possible with crypto, because these things, because there's no manufacturing plant to point at, or any specific sales to show as proof of adoption or attraction for a product. And so people will make big mistakes in terms of how they engage with what is, we are speed running the monetization, the bootstrapping of gold, which was a 6,000-year process, and we are doing it in the space of a generation, in our lifetimes at least. and that is unprecedented. And it's only possible because technology moves so much faster. Every generation, really, technology has, over the last 200 years, technology has seen a marked uptick in the speed of adoption. Whether that's going from radio, how long it took radio to go through the S-curve of adoption, how long it took to get into half of the homes in the U.S. It took quite a bit of time. It took decades. How long did it take smartphones to get into the pockets of half the population? Not very long. And Bitcoin is a little bit different because it is such a base layer of civilization, and it's harder to adopt than buying the latest tech gadget because it requires a great deal of conviction or a burning platform to affect change in your portfolio. But it is happening much, much, much faster than the 6,000-year process of gold monetizing. And what's tricky about that is that, if this is a process that has only just begun, and I think Chris is right here that we are not yet in the era of Bitcoin permeating everything. So for that matter, like as annoying as it was in 2021 when it felt like Bitcoin and crypto was being talked about everywhere, that's only going to get worse every bull market, I think. We're going to go from Katy Perry showing off crypto logos on her nails to it being in absolutely every business that you walk into. There's going to be, we accept Bitcoin, or set up your crypto savings account with us, etc. And because of that, because of how fast this trend is playing out, how early it is in it, the fact that we're going to speed run the monetization of gold in the span of a lifetime, people need to be very careful that they're not making the mistake of their lifetimes by buying in on snake oil, on crypto snake oil of whatever form, and instead taking care to understand and have conviction around what is lasting here, and placing their portfolio accordingly when they have the sufficient understanding to be able to withstand the volatility along the way.
Yep. Well, I think this gets into an interesting topic we could cover. Again, bringing it back to Fidelity, been around for 75 plus years, and inarguably the first 32 years of my life. Like I remember when we got caller ID, then we got AOL, and then fast forward, we had high-speed internet, a smartphone, we've got Bitcoin. Like that was a massive step function improvement in the technology that we leverage as humans. Like literally the pace of change is, people would argue, so fast that it's really hard at a chemical level for us to even process it. And so Fidelity weathered that storm and provided their clients extreme value throughout all that. And so like moving from the analog world of the Industrial Revolution now into the hyper automated world of the digital revolution that we're living through right now. And arguably Bitcoin's sort of the last piece of that revolution. You get digital money after the internet and all these consumer applications, and it's really the cherry on top that brings everything together, like navigating those hyper volatile transitions, how humans actually leverage tools and the types of tools that they're leveraging. Like, how have you guys weathered that storm? And moving forward, things get more crazy, which I think they will, particularly with Bitcoin and things like AI. Like it's only going to get weirder from here.
Yeah, definitely. On the acceleration point, one of the things I like to reference in talks that I do, or when, especially if it's to a big group or on stage, but also with clients too, it kind of can resonate with them, is everything you're talking about here. And Jesse was talking about the acceleration of all of this. Jeff Booth talks about this a lot. We as humans are terrible at extrapolating things exponentially in our minds, right? We're linear thinkers. And he always uses the example, if you fold a paper 40, 45 times, provided you could do it on an atomic level or you had the strength to, how high would it be? Most people guess a few stories, maybe as tall as the Empire State Building if they're really aggressive. And the correct answer is from here to the moon, 250,000 miles, right? And the other illustration I like to give is one I've seen before where I'll put up two pictures, or I'll show one picture first, which is the Wright brothers in Kitty Hawk, North Carolina, showing the first demonstrated flight, right? 1903, they flew their plane a few hundred yards or something like that. The second picture is Neil Armstrong on the moon.
Yeah.
And guess how many years those two pictures are apart? They're only 65, 66 years apart. Yeah. And so I say, if you were a young person on that December day in Kitty Hawk, North Carolina, and you just witnessed this first flight ever, they proved that it could be done. And they said, okay, you now know it can be done. Where do you think this goes in 65 years? Not a single person on that field would guess we'll have someone on the moon, let alone we'll have Boeing 747s shuttling millions of people around the world every day like it's nothing, right? We're just so bad at predicting technological change like that at that exponential rate. And so, I mean, that's our job at Fidelity to try to navigate this. It's why Fidelity built Fidelity Center for Applied Technology, which I talked about earlier. It's why they continue to experiment with things like AI and quantum computing and all this stuff to see how it could fit into our financial world. You're talking about the first caller ID and someone else said, yeah, Fidelity's history, how did they navigate it before? One funny thing in their history that I remember seeing when I first started was they were, I think, the first to implement being able to buy mutual funds over the phone. Like either first with a person and then actually like a touch tone phone, like one of those automated things, which just seems so funny and archaic now, but of course was revolutionary at the time. So it's those kinds of things where, you just have to keep innovating, keep taking advantage of what's coming out there to serve your clients.
Yeah, and it's like going back to the Jeff Booth line. Like we're very linear thinkers. We can't think exponentially, but human history has showed that we've had these exponential step function improvements. And when it comes to Bitcoin, like that's the one thing I personally try to get through to people. It's like, hey, yeah, it looks stupid. It's slow. It's really far. And there's a bunch of crazy people that are into it. But if you really dig into it and look at the fundamentals and how everything works, like there's something there. And it is undeniable that it provides utility that has never existed before. And if you can grok that, you may not be able to fathom the changes it will bring to the world at this current moment, but you have to at least accept that human history have shown, like when something like this is dropped on humans, we take it and run to the highest extent that we can take it.
The other thing that works on institutions is drop a Charlie Munger or Warren Buffett idea on them. They'll usually resonate, which is invert, always invert. So to invert this is to say, do you think that in the, I don't know how many years it'll take, but in the future, it will be normal to think that we couldn't send money to whoever we wanted with a click of the button like we do in email? That it took 3 to 5 business banking days, or that international wires got stuck? Like that's just going to seem so silly that anyone ever put up with that and that we had that, right? So if you flip it around and invert it, you think, oh yeah, we are living in this kind of weird era that we just take all these things as normal, but we've been like fish in a water where, well, that's just how it is, right?
Email is such a good parallel. Like email, when you reference public and private key cryptography and you have a public address that anybody can send, or David Marcus yesterday, I think, was referring to. I never heard it in that form. And it's pretty simple. It's just like, if I go outside, I think the studio he was recording, Squawk Box in front of New York, was like, if I went out there, I could send an email to anybody. But if they asked for like money, now I'm trying to like figure out what app, and if they're in a different country, now I got like intermediary banks and I got to send a wire. Like just that inversion of like, should it be this hard? Can we imagine it's going to be that hard in 10 years is a nice framing. I think like we're all coalescing around this. It's all about like framing and positioning and meeting people where they're at, because ultimately everybody's coming at this from a different perspective.
Yeah. And on that note, I think we only have 10 minutes left, but I think another big underlying theme with Bitcoin, its adoption and where it is now, particularly at the institutional level, is the the generational aspect of it. Like the people in control of large swaths of money at the institutional level are a bit older. You have your crusty CIO who really doesn't want to make too many risky moves.
You're not crusty out there, Mr. CIO. We're
No, but there is this generational aspect where you have somewhat of, I don't want to call them Luddites, but there's this barrier, this mental barrier that exists at the institutional level where there's plenty of people our age in these institutions that get it and grok it and have a lot of trouble trying to get it past the investment committee, because it's just something they can't grok from a generational perspective for some reason.
And just to insert one additional, because I know with limited time, is where that BlackRock, BNY Mellon, and let's call it Franklin Templeton, there's been a few in the past 12 months, how that can potentially help or how you're thinking about it from your side. Like in that supporting that case for the CIO that would have naturally been a little bit less or apprehensive to this whole ecosystem, and how you see that helping in their journey.
Yeah, I mean, I think that gets back to the point of career risk, right? If you're the only one doing it, that's really risky for your career, especially if you're someone who's a high level C something, who's towards the end of their career. You don't really want to rock the boat at the end, right? You want to coast out maybe. But this is something we've seen in our survey data as well. Not necessarily the age thing, because we don't measure that, but more the structure, right? So the highest adopters, 70, 80, 85% or more, are high net worth individuals and family offices and some RIA firms, right? And that makes sense because those are individuals driving the decision. So they get bitten by the Bitcoin bug or whatever it is, and they're the ones that carry the torch in their small family office. There tends to be less red tape, less bureaucracy, so they can pull people along, or it's just their own individual decision. They have sole discretion, right? So that rings true. Whereas it's really this absolute extreme we see. Family offices are kind of in the middle. I think they were 37% last year, saying that they already invest in digital assets. And then on the other end of the extreme is pensions, endowments, foundations, exactly who you would think, where they have large investment committee boards and a lot of bureaucracy and red tape. And for good reason. Obviously, they're trying to preserve wealth in perpetuity for generations and generations. And so they have these things for a reason, but that means that it's a long, long process for them. And even if there's one person there, they have to try to get everyone else involved and convinced of it. So that's why we see that change in our results. And if I can take this a little bit in a different direction, again, with the last podcast you talked about the institutions that they're coming and maybe they're already here. Our last survey, our numbers went up again, where 6 out of 10 of our institutional surveyed participants said they already invest in digital assets. And we said, wow, that went up again. That's great. But 6 out of 10, that's a pretty big chunk. Why is this still such a small asset class? Mm-hmm. So we went back to our data set, and Matt on our team, Matt Hogan, he worked with our data provider and our survey provider with us, the people who are doing it, and really dug deep into the data. And we had some theories, and then the data confirmed it, that the reason we have such high participation, which says the investors are here, the institutional investors are here, but the asset class market cap does not reflect that, is because the people who are here are the ones with the relatively smaller AUM. Right? So the individual investors, the family office, the high net worths, and the big gorilla pools of capital, the pensions, the endowments, they're at like mid-single digit adoption, right? And so it depends on who you say institutional investors are here, who you're talking about, right? And the other thing is that the people who are invested, they're almost all invested at very small amounts, which isn't a criticism. I mean, Bitcoin and digital assets are a small asset class, so I'd question your risk strategy if you were 100%. But again, you have a smaller pool of capital. There may be 1 or 2% allocations. And so that's really what's driving kind of this head scratcher at first, where on one hand you hear the institutions are here. On the other hand, you look at the price charts and it's like, there's no way. That's just, the math doesn't check out.
Yeah. And that brings it back to the point you were making earlier about like when Bitcoin is 1% of the global asset landscape, then those big players need to step up to a 1% allocation in order to preserve capital, like in order to preserve wealth, which is kind of their mandate. They have to have that slice. So then you have this reflexive, structural bid for Bitcoin. And at the same time, Bitcoin issuance becomes increasingly scarce, as we know, every 4 years. And those two factors combine to create like this lift as Bitcoin grows. It's a positive flywheel. As Bitcoin grows in value, more institutional allocators need to bid for Bitcoin in order to have a representative slice of it in their portfolio in order to preserve wealth through time and not miss out. And the cycle continues. Given that there's less and less Bitcoin being created, it all just sets up for it's a scenario that gold can only dream of, really, because it's gold with a finite cap on how much gold there is.
Yeah. And when you put it like that, Jesse, it just made me think of once that becomes ingrained and really internalized at the institutional level, like the amount of thinking that's going to go into like actually getting exposure and not moving the price too far, too much higher than it is when they want to get in. And because that creates the feedback loop too. It's like, oh, I need to get 1% allocation, which means I need this much Bitcoin. I can't signal to my competitors that I'm doing this right now because they'll like that whole psychological battle that awaits us in the future is going to be fascinating to play out, because once that happens and they're fighting for the 1% exposure and they find out like what they thought was 1% is only 0.5%. Now they got to get more. It's an interesting debacle. But
Chris, is there anything that excites you? I know between it could be on behalf of Fidelity yourself, like Fidelity being around and looking at this ecosystem, you touched on all the things that most institutions haven't even like thought of yet, let alone have tried. So you're already ahead of the curve. Is there anything that you guys are looking at that you can share that is kind of like just interesting, you're exploring, and even if it's not from on behalf of Fidelity Digital Assets, on yourself being a Bitcoin advocate and looking at this space that you're excited to see over the course of the next couple years or for this cycle?
Yeah, so I'll mention one data point that I find interesting as a follow-up to what Marty just said, the reflexivity. We keep watching the exchange balances go down in the data. And I think this is the first time we've ever had a declining exchange balance potentially going into the next cycle. If we do, obviously, this is speculation, but if that were to happen, it's going to be really interesting to see how that plays out. Is that going to be kind of this musical chairs that people realize there aren't as many coins at the ready to absorb extra demand this time around versus the other cycles? So that's one thing we're watching on the investment team. The other data point, and we briefly mentioned this in another part of the conversation, was I put together two data sets of showing M2 money supply going back to the late 1800s. And this is the first time we have a contracting M2 money supply since the Great Depression. And we talked about this in our latest video we did, and I said, it's not surprising because since the Great Depression, all these central bankers said, we will never forget the lessons of the Great Depression. And to them, the lessons were, don't ever let the money supply contract, right? And that's what they did. They never let it contract until today. And so it's not surprising that we've got headwinds, because we've found in our research that Bitcoin is highly correlated or reactive to changes in the money supply, not necessarily changes in inflation, but the money supply first and foremost. And so it'll be interesting to see once that once that changes, or if or when that changes and the money supply goes back up again. It might not be immediate, but that's one of the things we're looking at too on the research side.
Yeah, it sure seems like there might be a convergence of timelines here of the halving is coming in 7 months, and we'll see when, because of the nature of the financial system, they have to expand the money supply, and that could begin in mid next year again. That's sort of my rough estimation of timing, and I could very easily be wrong there. But if those two forces were to converge, it creates the sort of the opposite dynamic of what happened in the tail end of the 2021 bull market, where the bull market forces were playing out, but we switched from a QE, quantitative easing, position to quantitative tightening right at the Q4 in 2021, and that just blew cold air on the party that was happening, and snuffed it out entirely. And we could have the opposite effect of switching from that regime of quantitative tightening, which we've had since Q4 2021, back to QE at the same time that Bitcoin becomes twice as scarce in terms of new issuance.
Don't bet on it. Nothing's a sure thing. But this has been a fascinating discussion. Chris, I want to thank you for taking time to do this. We were very excited for this conversation. Again, the work that Fidelity has done and that your research team has done over the years has been extremely valuable for the Bitcoin space at large. I think the annual report, like you said, is something that everybody in the industry looks out for and looks forward to, because you guys are out there on the front lines interfacing with large pools of capital that are trying to understand this, and you guys are actually providing them good, genuine data that is needed. You're not selling them the snake oil. You're explaining to them exactly what's going on here. So just want to commend you, your team, and Fidelity. Abby, shout out to Abby for really being the tip of the spear on the institutional side of things for Bitcoin over the last decade.
Yeah, absolutely. This has been my pleasure. And you can go find all of our research at fidelitydigitalassets.com. We'll have that survey coming out hopefully this year yet. And then we also have a piece coming out on understanding proof of work. So this is a piece that I think is sorely needed in the space to help investors understand why we have proof of work and what it actually does and the implications for Bitcoin as an investment. So it pushes aside all the environmental stuff and it just says, let's understand what this actually does, why it's a very big deal, and what it actually means for your investment.
Yeah.
That's awesome.
And just want to commend Chris again for doing this while having a brief cold. This has been great. Michael, Jesse, anything to add here?
Just thanks for coming on. We were excited to have this, and it showed up. So we're looking forward to that and the research piece. And then also we guys know that you're working on a lot of stuff. So excited to see you continue to pave the way.
Yeah, fully agree.
All right. That's all we got today. We'll see you guys next week.